What if the most profitable bank customer is not the millionaire, not the business owner, and not the person with a huge salary, but the ordinary person who keeps paying every month and never fully escapes debt? That sounds harsh, but look at how the system works. Banks do not make their serious money when you are financially free. They make serious money when you are borrowing, paying interest, missing deadlines, refinancing, upgrading cards, taking loans, and convincing yourself that the next payment will be easy. A bank may look like a safe place, where your salary arrives and your savings sit quietly, but behind the scenes, banking is still a business. And one of its strongest products is debt. Now, this does not mean every bank is evil or every loan is a trap. Debt can be useful. A home loan can help a family buy a house. A business loan can help someone start a company. A student loan can help someone get an education. The problem begins when debt stops being a tool and becomes a lifestyle. That is when the customer becomes most profitable. Banks do not need you completely broke. A completely broke customer cannot pay. What they want is something much more profitable. A customer who is just comfortable enough to keep making payments, but not free enough to stop borrowing. Think about a credit card. On the surface, it feels like convenience. You swipe now and pay later. You get rewards, cashback, points, travel miles, maybe even a premium card that makes you feel important. But the real game begins when you do not pay the full balance. In the United States, credit card debt crossed $1.2 trillion by the end of 2024. Consumers were assessed around $160 billion in credit card interest charges in 2024 alone. That is not a small side business. That is a massive money machine built on people carrying balances month after month. Let's make this simple. Imagine you buy a $1,000 phone on a credit card with an interest rate around 25%. If you only pay $30 a month, your first payment does not simply reduce the phone price by $30. Around $21 can go toward interest in the first month alone. That means only a small part of your payment is actually attacking the original purchase. The phone starts getting old, but the debt keeps breathing. That is why the minimum payment is one of the smartest psychological tricks in personal finance. It looks helpful. It says, "Do not worry, you do not have to pay everything today. Just pay this small amount." In that moment, it feels like relief. But the minimum payment is not designed to set you free quickly. It is designed to keep the debt alive. You feel responsible because you made a payment, but the balance barely moves. The bank gets paid, the interest keeps growing, and the purchase you made weeks or months ago keeps following you into the future. This is why debt is so powerful. It turns time into money for the lender. The longer you take to repay, the more profitable you become. A person who pays everything back immediately is not nearly as profitable as someone who carries balances, pays late fees, uses overdrafts, takes personal loans, and keeps refinancing. The most profitable customer is often not the richest customer. It is the customer who stays in the system, month after month, always paying but never fully escaping. Banks also understand human emotion very well. They know people do not always borrow because they are careless. Sometimes people borrow because life is expensive. Rent goes up, groceries cost more, medical bills appear, cars break down. Families need support. And when income cannot keep up with life, debt starts looking like a bridge. The danger is that many people do not notice when the bridge becomes a cage. What began as a temporary solution slowly becomes a monthly habit. That is why loans are advertised in soft, friendly language. They do not say, "Come give us years of interest payments." They say, "Make your dreams happen." They say, "Upgrade your lifestyle." They say, "You deserve it." A personal loan is not sold as debt. It is sold as freedom. A credit card is not sold as borrowing. It is sold as confidence. A car loan is not sold as a long-term obligation. It is sold as the feeling of driving something new. The emotional packaging is beautiful, but the contract underneath is still math. And math does not care about emotions. Interest keeps moving whether you are happy, stressed, tired, or regretful. The excitement of buying something fades quickly, but the payment remains. The new phone becomes normal. The new car becomes routine. The vacation becomes photos in your gallery. But the monthly deduction keeps arriving like a reminder that part of your future income has already been promised to someone else. This is also why lenders love monthly payments. A big price makes people hesitate. A small monthly number makes people comfortable. A $1,200 item feels expensive, but only $50 a month sounds manageable. The price did not become smaller, it just became easier to accept. That is how people are trained to think in payments instead of prices. One payment for the phone. One for the car. One for the credit card. One for the personal loan. One for the furniture. One for the emergency from last year. And suddenly, your salary arrives already divided before you even touch it. The deeper problem is that debt quietly steals choices. When you owe money, you cannot move freely. You may stay in a job you dislike because payments are due. You may delay starting a business because your monthly obligations are too heavy. You may avoid taking risks because debt has made your life fragile. That is the hidden cost most people never calculate. Interest is not the only price. Stress is a price. Lost freedom is a price. Delayed dreams are a price. Banks benefit when people confuse access with ownership. A credit card gives you access to money, but it is not your money. A loan gives you access to a lifestyle, but it may not be affordable yet. Financing gives you access to products, but it also gives someone else access to your future income. That is why the smartest financial move is not always earning more. Sometimes it is needing less from lenders. Before taking debt, ask what the debt is doing for you. Is it helping you build an asset, increase your income, or survive a real emergency? Or is it helping you buy a feeling? There is a big difference. Debt used with a plan can be useful. Debt used for emotional comfort can become a trap. The bank will not ask these questions for you because your confusion can be profitable. Pay attention to the total cost, not just the monthly payment. Read the interest rate. Check the fees. Look at how long you will be paying. Ask what happens if you miss one payment. Ask whether you are buying something you truly need or just escaping discomfort for a moment. These small pauses can protect you from years of regret. The goal is not to hate banks. The goal is to understand the game. Banks are businesses, and debt is one of their strongest products. Credit cards, rewards, easy loans, and installment plans are not offered only to make life easier. They are also designed to keep people borrowing, paying, and coming back. Real financial freedom comes from becoming harder to profit from. Pay in full when possible. Avoid borrowing for things that lose value quickly. Build an emergency fund so every surprise does not become a loan. And never think approval means affordability. Approval only means the lender believes you can keep paying. In the end, banks do not need you to fail. They just need you tied to payments. Before you accept the next loan, card upgrade, or easy monthly plan, ask yourself one question. Is this giving me freedom? Or is it quietly taking it away? Because real financial freedom begins when your income belongs to you, not to debts from the past. And if this message made you think differently about money, share it with someone who may need that reminder today.